It says 10-second delay, and I didn't put a countdown clock, so just let's see if it works. Gosh, I'm on the
10-second delay, and I didn't put a countdown clock, so just let's see if it works.
There it is. Okay.
I'm on the 10-second delay, and I didn't put a countdown clock.
There we go. I am echoing all over the shop because this is the first time I've done it. So hello, everybody. Me put myself into the main. Oh, and I've got a daughter who's just gone crazy. Leia, I'm literally just on live. Okay, so welcome to this live broadcast with a struggler, Leia. I'm just about to do a live broadcast about CBDCs. Now's not a very good time for this.
I want to bury you.
Rowan, on that note, I'm going to let you introduce what you are up to and introduce yourself whilst I take care of this hilarious BBC intervention. Hang on, like the guy with who was introducing the, let me just put your face in the main block. There we go. Rowan, it's all yours. I'm going to put myself.
All right. Thanks, Izabella, and very nice to be on a panel with you all, and thank you for taking the time on a Monday morning. So I have had the opportunity to work with Congressman Lynch's office, including his fantastic economic policy director, Davina Khanna, on this bill with my colleague Raul Carrillo for a while now, and it represents the culmination of a pretty long-standing effort to change the way that the digital dollar conversation has been taking place. Up until now, the conversation has been almost exclusively framed through the lens of central bank digital currency. And I think a pretty obvious example of that is the recent Biden executive order, which uses the term CBDC pretty much interchangeably with the digital dollar. But there's a problem with that framework, which is that the term central bank digital currency doesn't actually tell you anything about the instrument, the technology, the intended audience, the use case. The only thing that term actually tells you is that it's going to be issued by a central bank, which if you're a central banker makes sense, because the first thing you want to do is make sure you're in charge of the conversation, in charge of the narrative. But we end up falling into a trap when we adopt this framing, because the very next sentence that typically comes out in these discussions is a conversation about the limits of what central banks can do, what their competencies are, what their interests are, what their commitments are. So where the conversation around the world has gone with CBDCs is that it's going to be, or looking very likely to be in most situations, an account-based system, a two-tier system that is intermediated through existing banks and payments providers, that it's not going to have full anonymity, and that it's going to adopt the AML KYC framework that's typically applied to account-based instruments. That is to say, it's going to require some form of identification in order to open an account or establish a wallet. And from our point of view, this was very problematic because it basically not only kind of slotted into, but basically extended and sort of turned to hyperspeed the existing war on physical cash. So when we were looking at digital currency, we wanted to start from the idea that the goal was to preserve the privacy and anonymity features of physical cash as much as possible in the digital world. And that meant moving away from the conversation or the debate between whether or not we should have a centralized ledger or a distributed ledger to ask the question of whether or not we should have a ledger at all. Because one of the unique things about physical currency is that any transaction that takes place, even if the instrument itself is issued by a central counterparty, the actual transaction that takes place between two actors does not create a permanent data record or ledger or require a third-party approval or submission to a common ledger for the transaction to be validated and finalized. So in order to achieve that kind of functionality, that is to say no ledger, no requirement of any third-party approval, validation, or involvement, the obvious technical approach was to use hardware-based security, which in fact is pretty much the definition of physical currency, whether it's metal coins or paper currency notes that have special ink, special paper, special watermarks, special barcode signatures, etc. The history of cash is the history of hardware secured elements. Perhaps my favorite is the tally stick, which was a piece of wood that had notches carved into it to indicate the value, and then was split into two pieces. And those two pieces had a unique kind of ridge when the time came to pay the issuer back for taxes and things like that. They'd simply match the two pieces together like a analog version of a public-private key pair. And so when we started developing this technology, the obvious institution for it was the Treasury, because in contrast to the central bank, which didn't have much interest in issuing a retail instrument, the Treasury has historically been responsible for issuing not only coins and notes, but also prepaid debit cards. And it actually has a long track record of providing retail services, both in terms of public payments and in facilitating all sorts of other payments on behalf of state and local governments. And also the Treasury has a much wider institutional mandate. It deals with questions of crime, it deals with questions of privacy, it deals with questions of accessibility and inclusion, it deals with coordination with the rest of the government, often things like the Financial Stability Oversight Council. It deals with systemic risk, or the Financial Crimes Enforcement Network, which deals with criminal issues, are usually coordinated through the Treasury, recognizing its historically central role in the US government. So the bill is designed to take privacy seriously. It's designed to provide a genuine public good, and it's designed to be complementary to the central bank digital currency discussion while sitting outside of it, reflecting a different institutional politics, institutional history, and sort of vision statement for the technology. I'll stop there so that I don't speak for the entire time. I hope that's enough for you, Izabella. Yeah.
I've removed myself. So yeah, I just wanted to say I'm sorry for that disastrous intro. That was thanks to my daughter running home, having had an argument about a bottle or something. But yes, I thought I'd quickly run through who is on this call and why in a sort of so we already heard from Rohan, who is the, I guess, partial architect of this new proposal that we're discussing, which is whether or not CBDCs, if issued by the Treasury, whether this can fundamentally change their characteristics and whether and their sort of privacy, exploits or not. But also joining me on the call is a range of different people, because I wanted to get many different perspectives across and make the conversation as diverse as possible. So we've got Robert Macaulay, who's a veteran central banker, formerly of the New York Fed and the BIS, representing sort of the central bank perspective, not necessarily a CBDC fan, but or biased in that sense, but at least giving us that perspective. We've got Brett Scott, who is he's standing by in the background. He is a independent journalist that has been covering crypto and all matters financial, monetary for a very long time. And we've got Roger Bass from Global Standard and Douglas Jackson. For those who don't remember, Douglas Jackson was behind the eGold initiative many years ago, and he's now working with Roger Bass on a new challenger system called Global Standard. So we'll hear from them, because I thought it was important to get a different perspective to push back against as well, Rohan. And finally, we've also got Nick. I'm going to this is one of my problems, Nick. I can't pronounce things. Margerison, who is joining me for what I'm kind of going to pitch as the Russell Brand perspective, which is, my view is that all of us here are financial geeks and CBDC geeks, and we've been looking at this for years and years and years. But there's a certain sort of new demographic that has joined into this discussion in recent years or months. And it's from the alternative side. And I thought it was important to broaden out this discussion, because one of these, I think Nick is very good at interfacing with the more sort of, one could say conspiratorial, but I think there are really very, clear and utterly fair concerns out there regarding surveillance and panopticon style sort of evolution in CBDCs. So, but I wanted to have a more lay perspective in the room as well. So Nick is representing that. But Rohan, before we get to, I'll put you back in the stream. Before we get specifically to just figuring out this system, how this system works. How do I get there? We go. This is like the CNBC Octobox disaster. Why is it just doing me? Okay, I'm just going to do it like this. So Rohan, tell us a little bit more about what is how it works in terms of the US system, because a lot of us might not be fully aware of what it means to put a proposal such as this in front of Congress. Like, what's the next phase?
The next phase would be to get other members of Congress on board, hopefully get people from both sides of the aisle. There have been Republicans who've indicated that they should support something like this, or this is the only kind of digital dollar they would support, people like Warren Davidson and Tom Emmer. We'll wait to see if they're actually interested in this bill. But then also trying to get others on the Democratic side so that eventually this bill would go to a full vote of the House and then be picked up by co-sponsors in the Senate and eventually go to the president for signature. Obviously, that's a sort of long way away, and there's a larger conversation now in light of the president's executive order directing the government to come up with a sort of comprehensive crypto vision. So it's possible that this kind of thing might end up being part of a larger suite of bills or suite of laws that include a CBDC, that include a regulation of cryptocurrency and of stable coins, etc. But at least in my view, this is sort of one of the most important because it hits those privacy considerations that a lot of crypto people ostensibly care about, as well as the kind of public infrastructure consideration that the progressives care about. The way that the bill is designed is that it starts off with a pilot program, initially taking 3 different sort of options to establish a proof of concept and see the range of technical options available to implement this kind of thing, including prepaid cards, something in a cell phone using a sort of trusted environment on the SIM card or on the device itself, and then later sort of ramps that up into a larger pilot that would be a sort of field test operating at scale with a large amount of the public, and then eventually a full rollout.
So, I mean, it sounds really interesting to me because I obviously have been a critic of CBDCs for a while, mainly because of my concerns about privacy, but also my concerns about, I think, just generally how, sorry, I'm just putting you guys on mute, generally in terms of how liabilities are managed and whether or not there is a sort of what we call in finance circles as a sort of crowding out of the banks, because if you effectively open up the central bank balance sheet to everybody, then people will be inclined to hold their deposits at the central bank instead of conventional banks, and that this might have a sort of unintended vicious circle sort of effect where you get a capital flight from the banks and possibly also leading to spiraling in interest rates as banks try to woo that money back. Do you think the model as you have proposed it tackles those 2 issues, or just the privacy one, Rohan?
Yeah, I think it does. So the first thing is that because this is designed to be a cash-like instrument, it's unlikely that people are going to wholesale leave the banking system to use it, for the simple reason that the privacy and anonymity and a bearer instrument model is a double-edged sword. What you gain is that nobody is involved in your money, and what you lose is that nobody is involved in your money. So that if you lose your wallet or lose your device, you don't have anybody you can call to do a fraud prevention or a cancellation on that and to restore your funds. So most people keep a debit card, a credit card, and cash on them in some combination. And this is likely to slot into the role that's currently performed by physical cash there, rather than to sort of result in a large-scale exodus from the other 2 forms of money. But the other thing is that this is unlikely to earn interest. It's designed to function like regular cash, and the most people are unlikely to want to give up, the other benefits that come with the bank account to store all of their money in cash, because you have additional sort of, earning of points and all those kinds of things that people actually enjoy. So this is designed really for people that care about privacy per se and want to make sure they can have that kind of privacy in transactions when it matters, not all the time, but perhaps when it matters. And then the other part of it is that we input in the bill specifically a requirement that the Federal Reserve compensate and counteract any outflow that might occur by providing additional supplementary liquidity to the banking system, which is, I think, what can happen already with central bank digital currencies is that you can simply supplement that lost liquidity with liquidity by the central bank. This bill provides the Fed explicit authority and direction to do that in the small chance that this has any notable effect. But I think it's going to be quite minimal in the same way as physical currency, notes and coins has a pretty minimal impact on overall liquidity conditions. You're on mute, Izzy.
This is such a disaster in terms of technical, skills. I'm sorry. What I was going to say is, before we get to the central bank perspective, what you're saying essentially, as far as I understand, is that the digital dollar, if issued by the US Treasury, will be device specific. So the token will reside on your device, so not on an account. So there is no ledger, there is no sort of central accounting system that is effectively managing your data in that way. There is an issuance of tokens. The tokens are outstanding and they reside on specific devices, but whether it's mobile phones, cards, chips, whatever. And in that way, like when we were talking the other day, if you were going to effectively cap the physical cash, the digital cash component, you could set like denominations like you do with bills today. So you could have like a $100 device or a $1,000 device, etc., etc. So say cards could be $100 and mobile phones might be 1,000. So if you are going to exploit that from a KYC or anti-money laundering perspective, you would have to have like 100 different devices or 1,000 cards. So instead of smuggling suitcases full of like bills, you'd be smuggling loads of mobile phones, hypothetically. Now, the immediate response I've had after writing the piece is some sort of general skepticism as to whether that technology is really foolproof. So tell us a little bit more. A, is that a correct understanding? And B, in terms of delivering on the technology, has this all been worked out technologically? Have you been, is it a fait accompli, or is there any comparable system that's out there that has already been tested? Like, tell us a little bit more about the technological wizardry that makes that possible.
Yeah, I mean, the first thing is there's no security that's completely foolproof. So, I mean, anyone that claims that is lying. But I think in this context, one of the important things about having those kinds of denominational limits baked into the hardware is you're still preserving the privacy there, because it's the hardware itself that's doing that, rather than a sort of external third-party surveilling or monitoring entity. So if you compare that to, for example, an account-based system that says we're going to have some sort of identity shielding at a lower denomination, in order to actually apply that shielding, you still need someone who has the ability to sort of uncover those transactions if they so choose, and in doing so basically keep a backdoor key. But because this would be done by programming it into the device initially, that's unlikely to be necessary. In terms of the risks, there is existing hardware secured options. We've had prepaid stored value cards since the early 90s. The Central Bank of Finland actually introduced a card called the Avant card in the early 90s that performed this function. Others like Mondex were issued by commercial banks. China's issued an offline capable form of a hardware card with their system today. And there are other companies like eCurrency Mint and WhisperCash that have got technologies that have passed various inspections. eCurrency is currently providing the technology for the Central Bank of Jamaica, although their particular specifications don't match what we're talking about here. The other big advantage, in addition to the hardware security, is just the legal advantage, but not having a third-party intermediary or ledger at all, which is that you don't lose a reasonable expectation of privacy. Since the 70s in the United States, the assumption is if you share your financial information with a third party, which includes your own bank, you lose the reasonable expectation of privacy. But with this kind of device, because it's simply you and the device, you keep that expectation of privacy. So on one hand, it's unlikely to be perfectly secure. On the other hand, no technology is, and we've had centuries of, the Secret Service and anti-counterfeiting efforts that will probably continue and need to continue and take a different form. but crucially, they won't involve your money itself snitching on you and the technology itself becoming a tool of surveillance and oppression. And also that the benefits to privacy and civil liberties here outweigh the kind of monetary risks of hacking and cracking. But I think it's important to note that when it comes to illicit finance in particular and financial crime, it's the standard banking system that's the primary agent and vector for that kind of activity today. You know, you don't need a novel digital currency instrument to launder money. You just need to have an account at HSBC. So the idea that this is going to be a unique threat to the integrity of the financial system, I think, is overblown, especially when the privacy benefits are so high. You're on mute again.
Again, I am literally the worst producer here. Luckily, there's a professional radio host in the room. I wanted to ask Robert, what do you think, based on everything you've heard so far, like especially compared to, say, the CBDC conventional system? What is your immediate sort of knee-jerk take on this new structure that's being proposed?
Well, it's a question you posed in your article, Izabella, and it's the question of stripping the conventional funding of banks. We've talked about it a little bit and how maybe under normal circumstances that would not be a problem, but I'd sort of like to raise the question of what happens if there is widespread doubts about the condition of the banking system or concerns about the technology that the banks rely on, or some other source of anxiety about bank money, and what happens under those circumstances? What happens if there is, despite any limits kind of hardwired into the system, there's big flow into this instrument that doesn't just come out of cash, that's really a flight to quality into the Treasury e-money that comes at the expense of bank accounts. What does the Treasury do with the money? How does that work? In some ways, I guess that's a question that is not unique to a Treasury version of digital money, but is a common question.
Rohan?
Yeah, so thank you for the question. I think the first thing is that, yes, you're right. I don't think it's unique to a Treasury-issued dollar, and I think relative to an account-based CBDC or a Fed account, this is likely to have a lower chance of that, just in part because, as I said, you know, people are going to be giving up some of the chargeback protections and the anti-fraud protections and things. But I think the other way to think about this is, if people do fly to this, then that's an indication that it's offering something that the banking system hasn't been offering up until now. And the only question then becomes, if we think that there is a public good in having banks continuing to be able to lend, is there a way to do that without requiring depositors to serve as our hostages? Is there a way to provide the banking system with the liquidity it needs without forcing consumers to sort of front that liquidity? And I think the answer is yes. We have a central bank. We have an unlimited amount of liquidity. I think the word that Neil Kashkari used in the depths of the COVID crisis was infinite firepower. And I think historically speaking, we take whatever the current state of liquidity is, and then we adjust conditions through our monetary policy tools. So I see no reason why this particular kind of liquidity outflow is insurmountable relative to every other form of liquidity crunch that the monetary policy has been successfully able to deal with. So I guess that's sort of my answer, is that, you know, I would be much more comfortable with an expanded provisioning of central bank liquidity along the lines of someone like Kaminska, rather than continuing to sort of require depositors to be the front line.
That's an answer to what happens in terms of monetary aggregates, I suppose. But from a kind of banking standpoint, what would be the asset that the Treasury would take on in response to a sudden jump in its liabilities?
Well, coins don't actually have a corresponding asset. They're not even recorded as a liability on any balance sheet, and neither would greenbacks. So this would fit in with that category. I mean, I think we're so used to thinking of every entity as having two sides to its balance sheet that we sometimes don't consider that the Treasury is unique in that it doesn't need anything on the other side of its balance sheet. In fact, the federal budget commission in 1967, when it created the new current budget structure, said that the largest asset that the Treasury owns is arguably its taxing power. But there was no way to give that a quantified value, so that they just took it off the balance sheet entirely. Because how do you assess the future tax power in nominal terms today and sort of value it next to other land and other assets? So I think the answer is that people would go into this instrument, the supply of this instrument would increase, and that would be it. And if the central bank needed to offset that outflow by issuing its own liabilities, it could do so, but that they would simply just exist in the way that coins exist today, which is with no corresponding liability on anyone's balance sheet.
Help me out. I'm not sure this is an accounting question that we're pursuing here. The Treasury is getting an inflow of money. So however you account for the new liability, what do you do with that money?
Well, depending on how it's structured, it could be that the Treasury is simply paying for things with an outflow of this new money rather than getting it in. So you could imagine it potentially reducing the amount of public debt that needs to be issued, which again can be easily offset by the Fed if need be. Or simply you would just have an increased amount of government issued instruments and a smaller amount of private bank issued deposits. So you would still have roughly the same amount of overall net financial assets held by households and businesses. It's just that those net financial assets would be primarily issued by the government instead of issued by the banking sector. I'm not sure if I'm missing your question, but I think the short answer is that the money, when money flows back to the Treasury, it just gets destroyed. So the instruments, what would happen is that somebody would take $100 bill and take it to the bank and ask for $100 of digital cash, and the $100 bill would simply be destroyed, and that bank would have less outstanding reserve balances at the Fed, and the Fed would be less leveraged, and the Treasury would be more leveraged, but the Treasury's leverage wouldn't show up anywhere on an accounting balance sheet.
I'm not sure I'm with you all the way, but let me go on to a couple of questions. Would the money that the Treasury takes in through this door, this window, be subject to appropriations process?
No, because the Treasury wouldn't be holding it. Individuals would be holding it. In the same way as when the Treasury issues a coin, it doesn't subject that coin to any appropriations process. Now, if somebody is transferring existing value in exchange for it, then the Treasury would reap that seigniorage benefit instead of the Fed. But that's exactly the same as if somebody were to take bank deposits and swap it for reserves today, and the Fed were to remit that as net operating profits back to the Treasury. They would both simply result in a lower deficit over time.
Brett, you have a question.
Yeah, I got some pretty just basic questions, which is to clarify some just basic technical details. I think I already know the answers to these, but for the purposes of people watching, am I right that much like physical cash, I cannot use it to buy things on Amazon, for example? One of the properties of physical cash is it's local and peer-to-peer. I have to be physically facing somebody. I can't use it to initiate remote transactions. And that's one of the reasons why there's always a kind of, you were talking about this balance people have between the cash they use and these digital forms of money they use. And one of the reasons why people want to keep digital balances is often they can use it for internet commerce and stuff like that, right? And it's also one of the reasons why I expect there wouldn't be a massive outflow from the banking sector if you suddenly had a digital form of cash that did the same thing. So am I right that you can't use this for like remote digital commerce? You have to be physically present, or have I got that wrong?
Sorry, no, that's a great question. So the short answer is that the technology is designed to operate device to device, but because what's being sent between the devices is information, that information can be sent across large distances. And the only thing is that there is no part of this network that actually provides that distance. So to give an example, two phones next to each other could transfer balances using a QR code under this system. That would be the sort of way that the cryptographically secured information would be represented from one phone to another. Now, I could take a picture of that and mail it to you, and you could then pick up your phone and take a picture of it, and that would work. Now, I could also be on FaceTime or a video call with you and hold my phone up, and you could hold your phone up and do that. But there's no tunnel between the two phones in the payments network itself. So I think the analogy there would be that you could sort of send money through the mail, and that would be using an external network to close the distance between you and someone else, even though the instrument itself doesn't do that. And the same thing would be possible here. My colleague Raul Correa has actually written more about how you might want to develop sort of specialized types of digital cash that can be specifically usable for remittances and things like that. But the short answer is some of the technologies already in operation today use a 10-digit code that you can essentially send, and that would be a way to allow for sort of non-in-person transactions, but still based on this hardware technology.
And just in terms of, let's just looking for more sort of cash parallels here. What's the interface between the banking sector and this form of ECASH? Because if I'm got a kind of let's say a Treasury-issued coin, and I take it to a bank, the bank can put that in its reserves and issue me some kind of bank money, right? A deposit, which is issuing outwards. Now, and then I can go to an ATM and reverse that process, cancel the deposit and get state money back. What would be the interface between this system and the banking sector in that sense? Would I be able to, quote unquote, deposit the ECASH into a bank, and how would I, quote unquote, withdraw it?
Yeah, thank you. Yeah, the deposit system would be basically the way you would go to a physical bank location today and deposit physical cash, except again, that could be done without you having to leave your house, depending on the kind of device. So if you had, for example, a wallet on your phone that was connected to your bank account or to your Fed account or whatever it may be, that you could simply do the equivalent of the digital deposit on your phone, like we do with a physical check, or we take the photo today. So you would say, I want to transfer that balance, and your bank would receive a notice that it is receiving $100 of physical cash, like you walked in and gave it to them, and they would have that recorded in their eCash wallet, and then would mark up your account. And then likely would probably have some specialized version of a hardware device, or would have simply baked in some sort of programming to their hardware device, so that if they get above a certain float, you know, $50,000 per branch or something like that, or 5,000 or something, it would just automatically transfer over to their reserve account, and the Fed would simply take that cash and destroy it. But the idea would be that, yeah, you would get used to withdrawing the cash from your account onto your device or taking it back on. And I think probably the closest sort of cultural analog, not technical analog, but cultural, would be the way that we currently use Venmo balances or PayPal balances, right? We have them linked to our bank accounts, but we also keep the balances sort of in that wallet and make a decision consciously how many dollars we want to leave in that versus how many we want to have coming directly from our account.
Again, apologies for rubbish producing. I was just distracted by a question directed at us asking why we're not talking about Will Smith, and I have no idea what that was about, and that's why I got distracted. But apparently he punched someone. So at this point, like, I think it's a really, you know, I've struggled with the CBDC architecture. I've been very worried about the privacy, and I've been very worried about this sort of centralized account that would have to manifest and manage everything. And obviously, just to play devil's advocate for the central banks, their proposition is that obviously they have an obligation to create a public good in the form of a publicly utilizable digital money, and they can add sort of tiering to it. So say the first £500 or $500 could be totally anonymous, and then beyond that you would have different levels of identity that you need to transact more and more, right? But in reality, when we've seen the implementation of pilot CBDCs or very sort of fledgling, I think Nigeria is a good example of a country that has recently issued a CBDC, that this promise of a public good has not really manifested the way one would expect. So there is still a inclusion issue. You still have to have a legacy bank account to be able to get one of these systems. So my concern with the CBDCs was that this excuse that they're creating a central bank digital good, so to speak, public good, was a little bit spurious, because there wasn't any sort of definitive, there's this fundamental paradox that they still have to maintain AML KYC authentication, which means that if you don't make the grade, you have to be kicked out the system to some degree, right? So how do you think, Rohan, that this fundamental paradox therefore is finally addressed in the system? And if it is, how is the Fed likely to respond? Do you expect them to sort of maintain their progress towards their own CBDC in the face of this new challenger? How is the relationship between the Treasury and the Fed likely to evolve?
I hope, you always hope, that the Federal Reserve will see this as a welcome development, because in part it actually takes the pressure off them to have to balance something that I think that they're not really able to balance, which is this sort of balance between privacy and AML KYC laws. They're kind of constantly saying, well, we know it has to be privacy respecting, but also we know it has to comply with all these laws. And I think that's fundamentally in tension. But I think the Fed recognizes that on one hand, because they are providing account-based services, that they need to have those kinds of equivalent AML KYC laws. Otherwise, it would represent a massive step backwards for that regime. But at the same time, they're aware that if everybody was required to provide identity to use a digital dollar, it would be unlikely to get the actual widespread use and trust that people assume or people think is necessary. So I think that this actually has the potential to square that circle by allowing people who care about privacy to embrace this, and those who care more about convenience or the sort of additional consumer protections that come with the intermediated system to use a CBDC. They aren't designed to be in competition with each other at all. And in fact, I think this is a useful way to sort of zoom out from the CBDC conversation and ask ourselves exactly which kinds of models are best suited towards the Fed providing and which might be better provided by others, rather than assuming there has to be only one model and having to kind of have a fight to the death between models that may actually be mutually complementary in different ways. I want to sort of have a little shout out to someone, the late Bernard Lieta, who used to write a lot about the benefits of monetary pluralism. He was talking in that context about complementary currencies along with a public currency and the sort of resiliency that comes with multiple currencies. But I think it's also true of payments instruments. There are horses for courses. There are different uses for different kinds of instruments. And as long as we assume there has to be one size fits all, we're going to have very messy, unpleasant trade-offs. But if we accept a kind of more pluralistic approach, then we can avoid some of those trade-offs and reduce the pressure for an entity like the Fed to do everything for everybody.
Muted again.
Yet again, I should just immediately take it off when you're in the little in the box, but never mind. This is a good way to segue to Roger, I think, speaking of pluralistic sort of models. Roger, I hope we were having a little bit of a delay before, but hopefully that has resolved itself. How do you, obviously, tell us a little bit about Global Standard and what it hopes to bring to the table in this conversation, and your criticism of CBDC models as they exist now, and how you possibly view this new Treasury challenger as it pertains to your proposal as well.
Sure. Thanks, Izabella. So I think I'd like to take that kind of the other way around. So I think it's really important, and often people often lose sight in these debates of a clarity about what problem or problems are we actually trying to solve. Fundamentally, it is about payments. That this is the purpose of money. And in particular, even the executive order talks about a focus especially on cross-border payments, because you have payments within a country are pretty efficient generally, and often free of charge, certainly for payments between bank accounts. In most developed countries, most people already have bank accounts. It's really cross-border payments where it's universally agreed that there's a big problem to be solved, where you have very expensive remittances, and the fundamental reason for the high cost of cross-border payments are the nostro balances that banks need to hold in particular 30 or so of these really big global banks that are the center of the global monetary system, and then the costs of exchange between currencies. So there's all of this discussion about central bank digital currencies, which have become terribly fashionable among central banks, but without actually really focusing on do they do anything to address those two core drivers of cost. And the short version is no, they don't. They do nothing to address those problems. The same kind of basic inefficiencies of that system are still there. But there is actually a way, and sort of our system, sort of our uniquely proven system, historically speaking, does eliminate both of those things. So ultimately, and in fact, even potentially quite soon, payments will be free, all payments, including cross-border payments. And this is actually not such a very strange or unconventional notion. It's really sort of just applying to the economics of cross-border payments the same model that makes domestic payments efficient, which is to say settlement in a single medium. And this is something which even central banks have kind of cottoned onto, although they sort of noticed it and then refocused elsewhere. And I'm referring here specifically to an assessment that was done in 2018 by 3 of the world's leading, most sophisticated central banks. This was the UK, Canada, and Singapore. And they were doing a conceptual assessment of different models for emerging digital transformation in cross-border payments. And they looked at various different possible future state models. But the one which they themselves said, quote, seems to most comprehensively address the pain points is a single universal money. They didn't use the word money, they used CBDC and so on. But a single universal money. Now, they went on to say, oh, this raises all kinds of difficult policy challenges. And so all of their attention has been focused since on other things. And in a sense, they're quite correct there, because to the extent that it is what the executive order in the US calls sovereign money, yes, such a money would be unavoidably hegemonic and hence would produce huge resistance all over the world. So focused as they were on sovereign money, they discarded the possibility that privately issued money would be able to achieve that goal. And in fact, it can, and it has. So historically, in the history of the world, it's a sort of demonstrable fact, although kind of widely forgotten, that there has actually only ever been one privately issued digital money, which worked basically, worked specifically in the sense of being widely accepted as a medium of exchange. And Bitcoin fails this test, in fact. So although there's some level of usage for Bitcoin in payment systems, in almost all cases, that entails a sort of an immediate exchange of Bitcoin for real money, so for local currency, in other words. And this was not the case with that one successful instance of privately issued money that there has ever been, which was eGold. And so our company is the 3rd generation successor to that original eGold, which was wildly successful up until 2008, when it was forced to exit the market through a a landmark legal case, which I should stress here for the record, is now provable as having been based solely on prosecutorial misconduct. So just not to get into details, the heart of that case was the notion that eGold was operating a money transmitting business without a license. That was something the regulations still today, it's determined at state level. The prosecution in the case went to the state regulator who said, no, they do not require a license. And this highly exculpatory finding was improperly suppressed by prosecutors. So there's a process, a case underway now to have that reversed. But so anyhow, that's just an important side note. But say that there was this one successful example, and sort of we are the successor to that entity. It's going to come back. There are various things in play right now, potentially coming to fruition quite soon. And our view is basically that once the successful workable model, which does solve the fundamental problem of eliminating cost in cross-border payments, once that comes along, all of the other stuff, the CBDCs, the crypto stuff, it'll just melt away like ice cubes in the sun.
So, Roger, in theory, though, you are entering the market on sort of, like, as you say, as a private entity, so in the spirit of competition. So do you see yourself as effectively complementary to a Treasury-issued or a Fed-issued CBDC? And then it would be the case of the market determining which one is the better one to use? Is that how you see it? Sort of fair competition, or... do you...
Yeah, well, so absolutely, the market will decide. We are not seeking any kind of special kind of official endorsement or blessing that says we are the only one ever. We think the market will decide, but that there are sort of demonstrable network effects that we see time and time again in different markets. And so we think there is that network effect that will kick in. We do not see ourselves as competitors to central banks. We see eGold emerging as what we call an alternative global currency circulating alongside national money. But the notion that a Fed, a Treasury digital cash, that there's any real, I think we would reject the notion that there's any real problem that is actually solving at all. And the market will reject it. So, but the market can decide that. It doesn't. Frankly, and that's even if it gets off the ground at all, because we've seen time and again in different jurisdictions that the banks are much less sanguine than Rohan is about the impact of any kind of CBDC or government issued money that's a proxy for the central bank money, and have basically sort of the lobbyists have said, no, this is not going to fly. So it's been shot down. Sweden is one example that comes to mind, but I think there are plenty of others. So we just don't focus on those kinds of things, these kinds of instruments very much, because we don't think they solve a real problem. And we think once the solution comes along that does solve a real problem, they're all just going to go away.
So can I just quickly ask, before we get feedback on both and how this sort of new multipolar currency world might work, how do you, so global standard is going, what's the denomination? Is it going to be its own unit, or is it going to be linked to any?
Yes.
Yeah.
So eGold, the denomination is grams of gold. So each gram of the digital currency of eGold, sort of according to the issuer's declaration of liability, must at all times be backed by a 100% reserve of physical gold in appropriate custodial arrangements, which is to say 1 gold of digital eGold equals 1 gram of physical gold.
Okay, so it's basically a new incarnation of eGold, but on a potentially kind of supplementary level. So you can have sort of domestic CBDCs settling domestically and then using eGold to settle on an international cross-border basis. Is that the idealized situation, or do you?
So just to be clear, how settlement works today, sort of all monies, all national currencies are their own separate system. they don't talk to one another. I mean, not at least as a kind of financial system. Of course, central bankers talk to one another. The way money moves internationally is through a process of exchange between those different national monies. And that's where the correspondent banks come in, and other people who will exchange one currency for another. So our money is just another money, and people can exchange it for local currency through people who are in the business of providing exchange.
Right.
But just to answer one other question that you asked there, it is essentially the core system is essentially, you could think of as a private sector monetary authority. It's doing the equivalent of what the central banks, the term they use is real-time gross settlement system, is doing. Now, there's a layer on top of that in every national system, which is the domestic clearing system. This is how banks clear payments between one another. And you have systems at the consumer level like Zelle in the US, and that are now consumers to make those payments between accounts as well. So there is an additional layer of the system that we're proposing and planning to implement this time that is the equivalent of a national clearing system, but operating on a global basis and clearing in the underlying settlement medium, which is e-gold.
So Rohan or Bob, actually, this sounds to me like another one of these sort of, when I speak to central bankers, they tend to sort of say it was Libra and DM that really accelerated the race to bring a CBDC to market, because they saw that this was sort of catering to a need that was out there, and if they didn't create something of that was essentially government backed to a certain degree, they would be outcompeted by private sector alternatives. Now, crypto has been around for a long time, but as we all know, those of us who cover it, the volatility within crypto and the fundamental sort of lack of I guess reserves or any kind of guarantor makes that a very not very effective currency for medium of exchange and for trade in general. What do you think then, in given that that was the reasoning for CBDCs to come on the market, the fact that something like Global Standard is going to emerge as another competitor potentially? Rohan, do you think that the two systems can coexist? Do you welcome that kind of competition? What's your perspective?
I mean, I think they can coexist. I don't have a problem with the competition, because I don't think it's actually much of a competition. I think that the history of gold standard based currencies is pretty terrible. I think that the history of deflationary currencies with a fixed unit account like that is pretty terrible. And I'm not particularly fussed about most of the reasons why central bankers got on board on a digital currency, because most of them are pretty risk averse and incrementalist and have a general attitude of it. If it isn't broken, don't fix it. So they definitely didn't get interested in all this kind of stuff before there were threats to their hegemony. But I think the reasons why it might be good to have a public digital currency option that preserves privacy existed beforehand and will exist after. And I think that a lot of those problems are not ones that are actually solved by the digital gold model that was just discussed. I mean, if the assumption is that the problem is cross-border payments, then that's going to lead you to a particular set of solutions. If the assumption is that the problem is that we've transitioned to a digital world where every kind of transaction that we do involves accounts and leaves a data trail, then having a system that doesn't do that, that can still allow for payments to be processed, is the important thing to solve. And I don't think that whether or not you're using a gold standard or a fiat standard is really the vector that matters for that question. But I don't have a problem with I'm not have a problem with it existing. I'm just happy to let it exist. I just don't think it's really going to do anything.
Well, just on top of that, before I go to Bob, and then I'm going to bring in Nick, with the Treasury issued currency, how do you expect it interoperating with other systems, and especially with respect to foreign ownership? Obviously, now we see this whole controversy about Russian reserves and effectively Russian money, who owns it, how it getting sanctioned, etc., etc. Do you see the digital dollar as you're designing as beyond those concerns, because it only pertains to, say, a small, like what was it, like $1,000 threshold that you perceive per person, or like, and to what degree will foreigners be able to use it globally and universally anyway?
I mean, I think foreigners can use it just like they can use physical cash. You know, you could take 2 cards out of the country and transfer between them if you wanted to. Nothing is going to prevent that from happening, in part because the cards are designed to work offline, peer-to-peer, without reliance on a network connection. So it shouldn't matter for the 2 cards whether you're in the basement in Detroit or in my house in Sydney. You know, it doesn't make a difference from the cards' point of view. In terms of the sort of broader geopolitical considerations, I think it's really important to note that it's less about the denominational caps on the instruments and more about the kinds of people that are anticipated to be using this kind of instrument. Companies and other large entities have their own reporting requirements and have other requirements on, you know, keeping cash in a float. That would make it very unlikely that you're going to have large entities storing billions of dollars in the form of prepaid cards or prepaid phone wallets. And when it comes to sort of oligarchs and billionaires, most of them have plenty of ways to get their money out that, again, are much more savory than using the equivalent of prepaid cards or gift cards. You know, colleagues like Atossa Abrahamian have written about the sort of market for passports. If you're a Russian oligarch and you haven't bought a second citizenship from one of the countries that sell that as a service nowadays, long before Ukraine was invaded, you probably weren't thinking very carefully. But beyond that, there are forms of crypto, there are forms of real assets, there's forms of, you know, jewelry and gold, etc., that will always exist for very, very wealthy people to move their money around, not to mention the entire art market. So the idea that this is uniquely going to challenge that, I think, is not true. What it is potentially going to do is give individual people the opportunity to continue using these currencies, even if governments want to suppress them from doing so. And in that respect, I think it's going to be a net positive for individual freedom and things like that. But it's unlikely you're going to have large corporations and billionaires relying on this because they've got much better ways to hide their money.
So I'm going to quickly throw to Bob and then Brett, and then we'll go into the sort of lay perspective with Nick. And if it's okay, we'll run a little bit over to 1:15, maybe 1:30, and we'll take questions as well from the audience. So Bob, what are your thoughts regarding the big conversation we've just had?
I think the safe prediction is more than half of the ECASH ends up in foreign hands, just as more than half of the regular current cash is in foreign hands. I think neither gold nor the multi-currency money market fund that was the center of Libra has a serious chance of performing the role that was described, though, something that made cross-border payments cheaper and easier is certainly a very socially desirable thing. If I could just state in 1 minute my summary of the earlier back and forth, as I understand it, as money flows into the Treasury, either the Treasury would pay down debt with it, or it would accumulate a balance at the Fed, creating a monetary problem that the Fed would offset by presumably buying treasuries. That's the inclination of the Fed. So either way, basically a big flow of money into ECASH produces a reduction of Treasury debt in the public hands. And that seems to me to be a real concern from the standpoint of pluralism versus centralization. It's a centralization of the credit and monetary mechanism of the United States and a defunding of the private sector. You can talk about holding depositors hostages, but you can also talk, as Izabella has, about the Gosbank problem when the government is sort of running all the credit in the country.
Quick reply, Rohan?
Yeah, I mean, the Treasury debt is a Treasury instrument. The e-currency is a Treasury instrument. Replacing one with the other isn't gonna increase the government's control over anything. And to the extent that people are leaving the banking system, we're talking about insured bank deposits, which are already government guaranteed. So I'm not sure that we're actually seeing a reduction in availability of private alternatives. We're seeing people moving from one form of government guaranteed instrument to another. And to the extent that we want to ensure that there's an availability of bank credit for purposes related to pluralism of the credit system, that the Fed has the tools to do that. I mean, we don't consider the crisis moment right now to be preventing banks from making loans just because the Fed has to pump additional liquidity in. I'm not sure why pumping additional liquidity in this situation has to be seen as an existential threat to the independence of the banking system. We've managed to have publicly provided liquidity be the backstop of the banking system for over a century now, and that's working fine. So I think the idea that the Fed's supplementing any liquidity outflows inevitably means Gosbank is not warranted, I think.
Izabella, actually, if I might jump in, there's a kind of a large-scale structural point, which I think is really crucial here. So we're having this conversation about sort of different types of money for different consumers and so on, but really sort of the heart of the international monetary and financial system is the critical core issue here. And you have the former governor of the Bank of England, Mark Carney, was saying the rise of a reserve currency is based, this is not quite verbatim, but is based on improving the cost and convenience of cross-border payments. So to the extent that it is possible to make those payments essentially free, the way domestic payments are, and it is possible now to do that in the way that I described, then I think there's very little, could be very little debate about that would have really vast implications. And so the critical issue at this stage is the regulatory framework and whether such a thing will be allowed to exist, specifically in the sense of banks being allowed to hold balances of this new privately issued money as part of their reserves. And there's a regulatory change recently, or specifically guidance from two key committees from the Banker for International Settlements, which is the body that all of the national regulators ultimately tend to follow. Although on this point, they haven't quite yet, but can be expected to do so soon. And that guidance basically says, this is the bright line difference between the good stuff that is sound and that banks should be allowed to hold within an appropriate regulatory framework versus the other stuff which they should not touch with the barge pole. And then there was another piece of guidance from another key committee that regulates payment market infrastructures. So the core infrastructures that banks use for moving money around, for making payments. And that was also basically saying, yeah, this is the framework that regulators, national regulators, should use. And so what we're basically saying in relation to this proposed system is regulators just need to say, and even a first mover regulatory authority, yes, we, the central bank of wherever, would like to express our tentative embrace of this BIS guidance. And this is not a big stretch for central banks because they embrace BIS guidance all the time. And based on that, the absolutely transformative efficiencies, economic efficiencies of that new system, we think will result in a world-changing ignition moment. It will be a shift in the foundations of the international monetary system. And this should not actually really be too surprising because gold and to a lesser extent SDRs are the two things which are the foundations of the international monetary system. In the case of gold, that's been the case for literally thousands of years. SDRs have only been around for about 70 years. So it kind of stands to reason that if you have something that is a perfect digital proxy for physical gold, that would be a large structural change in the way the whole international monetary financial system works. So that's what's just around the corner in our view.
I mean, I think Roger makes a fair point in that there's no doubt, I think, in terms of like the public perception of gold is very much, it is still perceived as a very safe asset and in so many different jurisdictions, Rohan. And I do think there's a sort of, within the central bank community, there is a sort of, I guess, a fairly kind of snobby way to look at gold in general. I mean, ironically, but I do think it's often dismissed as a challenger because of the fact that it has this material aspect to it, and it's not going to be very practical in a digital world. But if it can be digitally monetized, it does, I think, enter the domain as a potential challenger. And whatever you say, like e-gold was incredibly successful, and it was the definitive, precursor to Bitcoin before Bitcoin became a thing. So I that's why I wanted to get Roger involved, because I do think it is a worthwhile kind of thing to keep in the kind of spectrum of things that are going on. But Brett, you had a question.
Can I just clarify real quick? I didn't mean as an asset. I'm sure it's going to continue to be an investment asset. I meant as a unit of account used by a whole economy. That's what I was talking about. Not. Yeah. I'm sure it's.
I should clarify something here, because there's a common confusion on this point. So this is not. We're not talking about golds and assets. There are a lot of people out there doing digital gold as an investment. This is not what our company is about. We are money. The full name of the company is Global Standard Money and Settlement. But that is not the same as a unit of account. That's a really important distinction, that sort of the use before, the use as a unit of account, that would be an issue for the conduct of national monetary policy. But it's not the way our system works. We don't expect, we strongly discourage the use of e-gold as a unit of account. And in fact, the way payments were made before on the e-gold system, and will be again, implements what we call a decoupling of the numeraire. That's kind of a jargon term, but it basically means that payment instructions are specified in local currency, or in whichever currency, but a conventional currency. And then e-gold is the medium of settlement, but not a unit of account. It's a really important. It seems arcane, but it's a really important point.
So it operates as a bridging unit, effectively.
No, it's not a. Well, let me clarify that, because so the point is, there is no actual exchange involved. So this is perhaps a slightly tricky thing to understand. But if you've got two banks, let's say a bank in the US and a bank in India sending money, the two people at either end might not even need to know about e-gold. It could be dollars disappearing from the sender's account, rupees arriving in the recipient's account, but there would be no actual FX involved, because each of those banks would be holding a balance of e-gold as part of their reserves. And so the exchanges from the consumer's perspective, that would all be at par. So the specific test would be, you could send dollars, they'd arrive as rupees, that person could send the rupees back, and that would be the same amount of dollars received. So I mean, really free in that sense, not with kind of hidden exchange costs, but genuinely free, the way it works on a domestic system today.
So I do think that bridging currency or unit, I think, still is a fair way to describe that. But Brett, quickly, sorry, and then we'll go to Nick, and then back to Ro.
I would just always use this term, counter trade.
Yes, exactly.
Take one money price thing and swap it for another money price thing. This is how Bitcoin works as well. The same principle.
Yeah, but that's why I was pushing back on the bridging currency notion, because there is no. I'm sorry, go ahead. Beg your pardon. Yeah.
Not about the minutia of whether something's money or not. Ryan, I just want to ask you about the interaction between the ECASH system and physical cash system. So if I'm a person who currently has a preference for physical cash, is there do I see it as something that I hold in preference to eCash, or do they interact? What's the sort of like interaction between these two forms if I'm a pro-cash person?
Yeah, I think the first thing is that hopefully this gives you another kind of arena to continue to make the case for cash, so that you don't, that instead of cash being simply this thing that sort of continues to have a smaller and smaller sort of use case relative to the digital world, we can say actually cash is a value, and it has different manifestations in different contexts, but the same reasons we like physical cash, we like this other instrument, and that allows the two kind of approaches to mutually benefit each other in an advocacy and a cultural, imaginative perspective. In terms of the actual use cases, I think there are people for whom even a digital card that has an inbuilt, battery might be still risky, or a phone. You want to really prepare for that prepper moment. You might want to be preparing for loss of electricity in general. That's one thing. You may also prefer to trust, or again, to have a kind of resiliency approach where you have different trust for the code and the hardware of physical of a digital eCash versus physical cash, so that you may think that the most recent audit of that code is trustworthy, but you still want to keep some part of your money in cash, that kind of thing. There may be situations where the hardware is either prohibitively or just unfavorably expensive, relative to paper currencies, which cost nothing. If you have to still buy the card for $5 or buy the phone and keep it upkeep, that might make it less attractive than cash. So there's a couple of reasons why I think physical cash doesn't go anywhere. And I think the other thing is also the way that we've written the bill is to say that where people accept physical cash, they should accept this as well, with the goal of, again, trying to encourage the kind of laws like we just saw coming out of Philadelphia, requiring merchants to accept cash. So an earlier version of the bill actually said everybody has to accept this, but we took that out in part because we haven't actually won that battle with physical cash, and we didn't want this to sort of leapfrog ahead for the fight for physical cash, so that in the future other bills that are trying to preserve the acceptability of physical cash can piggyback and add this on as well, and that thereby increase the reach of actors for whom those sort of cash acceptance requirements might otherwise work for.
Brett, is that any other points? Because now I would love to get Nick's perspective. Nick's been sort of listening in on the whole conversation, and I thought it'd be just quite good to get a lay perspective, because we get very carried away with all the very wonky, terminology. Nick, what's your overview of the conversation thus far, and what questions do you have for any of the panelists? Oh, you're on mute.
It's been a fascinating conversation, and thank you to everyone for it. I'm going to give you my point of view on this and then see if and how you want to interact with what I'm saying. So Bitcoin, cryptocurrencies, we first covered that on my podcast back in 2013. And that was in the context of alternative media. So we're talking about conspiracy theories, unusual ideas, that sort of thing. Basically had an option of all comers. So anyone who wanted to talk about anything, I'd pretty much talk to them. And around that point, there were, let's not call them conspiracy theories, let's call them counter narratives. And there were a couple that I want you to have a think about. One was this idea that people are all going to be microchipped and controlled by the government. And in the future, if you don't toe the line, you'll be shut out of the financial system because they'll switch your microchip off. And there was another counter narrative going around at the time, which seems less fictional than that, which was that money is based on nothing. And when they print it, it makes everybody else's money worth less. So nowadays, quantitative easing. So Bitcoin was pitched to me in that context by a listener as an answer to the question of quantitative easing, what you do about the fact that people can print money and make your money worth less. And it was pitched along the lines of being kind of digital gold, which someone's referenced before. And the response from cynics was that Bitcoin was going to be the software, the code that would end up on the microchip. So 2016, the Fourth Industrial Revolution, great book if you've read it. Page 22 talks about how RFID chips are used to track products, and they'll soon be implanted into people. And that made me scratch my head a little bit as we watch as people are being shut out of the financial system, not just because they belong to the wrong country, but also because they think the wrong things, support the wrong causes. In other words, the low resolution view of the future offered by that conspiracy theory has rendered something in reality. We are seeing something like that, even if we've not got physical microchips injected in us. So how does this system that we're talking about here interact with Bitcoin, if it does, and how does it boot counter narratives?
Rohan, I think one for you in the first instance.
Oh, thanks. Yeah. So the first thing is, I think it doesn't really have anything to do with Bitcoin in the sense that it's not trying to supplant it or trying to sort of live in its slipstream. The closest thing I think it would have a direct relevance to is the stablecoin market, which is built up around Bitcoin. I think maybe the more honest Bitcoin advocates will acknowledge that it's probably problematic that what was supposed to be this sort of anti-government, censorship-free, completely separate unit of account-based currency has ended up becoming incredibly intertwined with something denominated in the US dollar that is incredibly dependent on access to the traditional banking system for its liquidity, or at least traditional financial assets for its collateral safety. The world in which we have digital cash like this might be a world in which there's less need for various stable coins to serve as a kind of liquidity buffer around the private crypto industry. In terms of the panopticon issue, I mean, I am concerned about panopticon considerations as well. I think anyone that sort of lived through Snowden, Reality Winner, and Chelsea Manning should be at least somewhat skeptical when the government promises that it's not going to look at your stuff, not going to surveil you, and isn't interested in building Dragnet-based digital data systems. So in that respect, I think this bill is for people who believe in privacy and civil liberties, but don't believe in private money per se. So if you think that having cash is good and you weren't sort of waking up every day worrying about the inflation of your dollars, but you still cared about privacy, then this is probably going to be the kind of technology that fits within your Venn diagram. I think for people that are concerned that government are debasing your currency, I mean, this is a real issue. We are experiencing inflation right now, but I think the alternatives of hard money, which is usually what's posited by pro-Bitcoin advocates, I think has a much worse historical track record. So I'm quite comfortable being on the side of public money on that issue, even if there are risks that we need to be careful about managing. But on the privacy side of things, I think people have a genuine reason to be quite skeptical or fearful of a lot of the digital currency conversation thus far. But rather than simply throwing your hands up and saying, sort of democracy's failed, society's failed, get a boat and live out in the Pacific Ocean and cease it or something, I think the answer is to demand a better kind of society, a better kind of set of institutions, and that this bill is an example of how to do that. If you respect freedom, but also accept that we're going to continue to live in a society, then we need to answer these questions through some form of collective governance, and I think it ends up looking something like this.
Thanks, Rohan. Nick, any other thoughts, or Brett? Maybe you might want to respond as well. I just feel like because Brett and I. Oh, hang on. I've left it on Rohan. I was just going to say, because Brett and I were around in the early, well, me less so than Brett, I think, but we were around in the fairly early days of Bitcoin, so that 2013 era. I recall it quite well, and it was very conspiratorial. It was incredibly kind of like, this isn't going to happen. These people are mad. And here we are in 2022, and you've got like major institutions investing in Bitcoin. So I've become more open-minded, I think, over the years towards like these, I think back in the day I was incredibly critical, as Brett will testify, but I have to, admit that the Bitcoiners were right in the sense that there was obviously a demand for this product, because if there wasn't, it wouldn't still be around today. So I've had to eat my hat a little bit. Brett, what do you think in terms of like how the narrative has shifted in that time?
I mean, we'd need hours to discuss the beauties and delusions of Bitcoin, probably. But I think the first thing to say in response to Nick is that, a lot of people were taken in by the sort of revolutionary rhetoric of Bitcoin, but they were Bitcoin is not the first to make all those concerns heard. Concerns about censorship and surveillance and so on have been going on for a very long time. All right, and I think what the Bitcoiners try to claim is they try to claim that mantle. They try to claim as if there was never previously some. Well, they're trying to create this idea that if you are pro-privacy, you have to be pro-Bitcoin and so on. And I have a big problem with this, right? I'm very pro-privacy, but I'm not. I think Bitcoin is a very flawed system. Most notably, how Bitcoin works is a lot of how like gold systems will work. You have a digital object that gets a monetary price through a speculative market, you can then use that object with a price to quote unquote buy something, but you're really swapping it for something else, right? That has a similar price. So this is why I think anybody who's interested in Bitcoin has to really learn about this concept of counter trade. You're really relying upon something first getting a price in the dollar market before it becomes usable as quote unquote money. Put differently, if I remove the dollar price from a unit of Bitcoin, it's not going to buy anything. It's relying on its dollar convertibility essentially to have this money-like quality. I'm sorry, it's a bit complicated, but basically the thought experiment to think about is what happens if you remove the dollar price from Bitcoin? Would you be able to quote unquote buy anything? No, you would have an empty digital object that you can move, right? So the whole sort of story of Bitcoin is essentially a system of, I just call them blank digital objects with monetary branding pasted around them. And it's been very, very successful at that branding. And that's basically what the Bitcoin system is, and whether you think that can replace the global monetary system, I mean, that's really depends on your ideological standpoint. But what's very obvious from a descriptive reality perspective is that it entirely depends on the US dollar system right now. So I don't know, I could go on ranting about Bitcoin for a very long time, but let's not do that.
Thanks, Brett. I was just going to add before I go on.
Izabella, if I could just respond quickly to I think there's an important historical point which was made credibly by Peter Thiel, who's a lot of people have heard of, who observed recently that Bitcoin was the answer to e-gold. That's an exact quote. He said that. So there were a lot of the crypto things that were around, and nobody. To the point that Nick was making in terms of people understanding sound money versus money that gets inflated away, people understood the difference. And while e-gold existed in the market, nobody was in the least interested in any of the digital things. It was precisely the disappearance of e-gold from the market that enabled Bitcoin and the rest to emerge. And so your point about government, sort of the alternative counter narratives and so on, in terms of the government stuff, you don't need to get into the notion of kind of people having chips physically implanted to think that government controlling money governments like control. Who could seriously doubt that sort of a government money, whether it's from the Treasury or the Fed or whatever, that when push comes to shove, there's going to be pushing and shoving. You just look around in the world today and you can see examples of that. So you can't really trust governments. And the notion that governments can put in place by putting some nice words in a bill that creates constraints which a future government is not going to be able to erode in the interest of some critical policy objective of controlling people, and that's just not the way government operates. So there's a historical example of kind of like, when you actually historically had a money, e-gold, that solved the problem in terms of making payments easy and cheap, people used it massively. Back then, nobody was interested in the crypto versions, and it was only when e-gold disappeared that Bitcoin emerged.
I think that's a worthwhile point, but Roger, I would argue, I think because the Bitcoiners aren't represented here, they would argue, I think, that the difference between Bitcoin and, say, your new e-gold system is that it can't be censored. Like, a government legislation can maybe ban it, but at the end of the day, you can't stop people running the code, etc. Do you think that the new e-gold is as resilient from government sort of legislative intervention?
Well, so let's be clear about, there's an important distinction here to make. There are two key points. One is the only real use case, in our view, for Bitcoin and cryptocurrencies is the evasion of government legal and regulatory authority. It's criminality, basically, or evading government authority. There is a notion that it became one of the founding myth for Bitcoin. This is a story which is told about what happened in the e-gold case, which is just not true, which was the notion that that a centralized system was always going to be vulnerable to government, that they weren't going to tolerate a competitor to the almighty US dollar, and that's why the government came after e-gold. It's not true at all. So so we're seeing all of this criminality now with these ransomware schemes and so on that are a direct result of this core architectural feature of cryptocurrencies, which is of resistance to government authority, resistance to legal control. But you can't have, when you have that, you enable criminality. The two are kind of glued together. What we want, what you should want, is a kind of system where kind of you can have laws that protect people against crime, and that requires a single entity which is accountable under the law. And so an efficient, a kind of well-structured system, the Amazons, Googles, all the rest of it, they're highly distributed systems with centralized administration. So you need to have central administration. Otherwise, you get the systems that are basically enabling crime.
So I get your point, Roger, and we're running out of time. So I just wanted to bring up the case of the Canadian truckers, because I think Rowan and I have shared thoughts about this, in the sense that you can't really have a democracy necessarily without the capacity to raise funding for a competing political group, say, and if the government has the right to confiscate assets or reserves, that compromises that possibility, right? And I think in the current situation, what with Russian sanctions, you realize it's not just a question of criminality, it's also a question of political kind of intent. And what I think has been quite shocking for a lot of financial institutions is this idea that, especially in the case of the Afghan central bank, that the central bank can just confiscate, that the government can confiscate reserves held at the central bank, right? And I think that has been a real eye-opener. And I was looking into the history of it, and of course we did have the same sort of thing happen in World War II, but in the post-war sort of environment, there has been a general perception of immunity to central bank reserves, held in different, that is definitely the makings of a civilized sort of stable system, the idea that you won't have your assets sort of stripped from you without some sort of legal due process, right? So I think what I wanted to finish on really in that context is, Rowan, would the e-Treasury, ECASH, would that help, protect, say, the Canadian truckers? Is that the sort of system that would in some way preserve those civil liberties, do you think? And maybe, Robert, to finish off, what do you think of, first Rowan and then last, just to get that question in, what do you think these precedents mean for the dollar standard more generally? So Rowan first.
Yeah, thanks. I think the first thing is I actually very much agree that simply writing words down in a bill is not the be all and end all of anything. But I think it's also important to note that this is also true of Bitcoin and e-gold. I mean, even just then we heard, well, on one hand, you can't trust the government. On the other hand, well, we can pass laws and hopefully the laws will only go after the bad guys and not the good guys. I think the reality is that that's true even of these cryptocurrencies, because often they build what they think is a completely private system, but it's built on a system of markets and property rights and contracts and accounting and insurance and tort and all those things that do require a government. And the difference is not that one is purely private and one is purely public, but that there are different cultural values and safeguards and different dynamics that would be involved in trying to overcome those sort of hard-won rights or hard-won private protections. And so when it comes to, for example, a bank account, it's very easy to turn it off because you have to go to the bank and ask for permission. Just like with a centralized entity that wants limited liability and wants to file an annual, accounting statement, you can simply deny their corporate charter if you wanted to. But it's a little bit harder to say we're going to confiscate the property of every single person in the country. You have to sort of send jackbooted thugs into people's houses and confiscate their stuff, unless you're talking about black homeowners in 2008, and then you simply allow the MERS mortgage fraud to do its work and to confiscate huge amounts of wealth without anybody saying anything. But when it comes to digital cash, I think the point is that what we're doing here is inculcating a cultural value that respects privacy, but does so within democracy, does so within public governance. The way that the Bitcoin crowd and previous generations, the way that the gold standard crowd would say is, you can't trust governments, therefore hedge against society. Create this instrument, and if the world turns to shit, if there's everybody is sort of living in the Walking Dead style apocalypse, then you'll still have had this gold, and it'll be no one can take it away from you. The reality is, of course, they can take it away from you. They can just come and shoot you. But if we have a value that says that private cash is as important as the ability to speak Navajo, or the ability to not snitch on your relatives in Europe in the post-war era or in World War II, then when people do start to engage in attacks on those systems, on those institutions, then there's an ability for the public to rise up, because they've been taught to value those things and been taught to value them through the lens of direct public action, through the lens of demanding a different kind of government. And so I think in this situation, we're not talking about a technology or even a law. We're talking about a politics of valuing privacy in public money. This is the money we all use. This is the money we all are invested in as the unit of account of our government, and it should work for us. And if it doesn't, we should have a politics that will stand up and defend it. So I think that's where I see this bill fitting in, and that's why I think it does have a unique answer to this question of sort of how do you get around having to trust a government that's fundamentally, potentially at odds with you, that is different from sort of trusting a technology or simply dropping out and hoping they don't come for you.
Thank you, Rowan. And last, sorry to cut everyone else off, but we have run out of time. So, Bob, what your final thoughts in terms of what something like the digital dollar from the Treasury might mean for the maintenance or sustainability of the dollar standard, or any other thoughts you might have?
A short answer, long question. I think the Iranian asset freeze back in '79 or the Afghani case that you mentioned, really quite different from the Russian central bank case, because of the joining together of many authorities. In the case of the Russian central bank, I don't think it has the implications for the dollar's future that many people imagine. I think it is the unilateral, away from the even allies sort of moves by U.S. administrations that it represents the real threat to the dollar's future.
That is a very good point, actually. I think and certainly when I was reading up on the history, I think that sort of multilateral approach is very different. You're right. Okay, well, thank you everybody for participating. I will distribute this far and wide. Do share it, do subscribe, all those cliches. I'm building my channel, whatever. And thank you, and good luck with everything, Rowan. And sorry for the absolutely shambolic start to this first premiere live chat, but I appreciate your patience throughout. So thank you, everybody, and I shall say adieu on that front. So
Thank you very much, everyone. Appreciate it.
Cheers.
Thanks, everyone.
Take care.